Okay, so for Chapter 17, we're going to talk about partnership liquidation. And these are our objectives. We're going to learn about the legal aspects of partnership liquidation, apply simple partnership liquidation computations and accounting, prepare the safe payment computations, understand installment liquidations, and learn about cash distributions for installments. Now, I may not go all the way to installment liquidations. I think I'm going to be mostly focusing on safe payments. Let's just see how far we decide to go. Okay, so the process of liquidation, we convert all the non-cash assets to cash, recognize the gains and losses and expenses, settle all the liabilities, and then distribute the cash to partners according to the balances in the capital account. There's this assumptions that have to be made. First, you assume that the business is solvent. The partners have equity in the net assets. There's no partner loans, and the partners assets are converted to cash before cash to partners. So the Uniform Partnership Act provides the following rank according to payments, for payments in partnership liquidations. The first thing you do is the amount owed to creditors other than partners and the amounts owed to partners other than for capital and profits. The amounts due to partners liquidating their capital balance upon conclusion of the liquidation and partnership assets and liabilities. So that's our order. All right, so in a very simple liquidation, you'll convert all the assets to cash, then make a single distribution to the partners in the final settlement. Gains and losses on conversion of assets are distributed to partners. You use established profit and loss ratios, and here's a big one, you ignore salary, bonus, and interest allowances. Okay, so let's look at the partnership of Hull and Kerr statement of partnership liquidation. This is for a period January 1 to January 31st over the period of 1 month. All right, so we take the balances, and you can see here, this is the balance in cash, inventory sold, sale of plant assets, collection of receivables. Basically, we're kind of shoring everything up and getting ready for the distribution. The next thing that you need to know is that cash, non-cash assets, liabilities, and partners accounts are adjusted as assets are converted to cash and cash payments are made. All right, so if you have debit capital in a solvent firm, all right, if one or more, not all, of the partners has a debit balance in the capital account. In other words, it's a negative balance. And the firm has sufficient cash and other assets of value to pay all the creditors. All right, so one partner is in the hole, the others aren't. Then the partner with the debit balance must either A, contribute to that amount to the firm, or if they can't come up with the money, then the debit balance is absorbed by the remaining partners. And then you keep the consistent profit and loss ratios of the remaining partners relative to each other. So the Uniform Partnership Act ranks amounts owed to partners other than capital balances higher than capital balances. However, a partner with a debit balance may offset the other amounts owed to the partner with debit capital account balance. So let's look at safe payments. A safe payment is a distribution that can be made to partners with the assurance that the amounts distributed will not need to be returned to the partnership at some other later date to cover any liabilities or realign partner capital. All right, so those are good things to have if you're a partner, because you don't have to go give it back later on. You assume that all partners are personally insolvent. Non-cash assets represent possible losses. Additional cash may be needed for liquidation expense. What do safe payments do and don't do? Safe payments determine the amount of advance payment, must be prepared for each cash distribution unless the capital balances align with profit and loss ratios. Here's what they don't do. They don't change the capital balances. They don't affect the statement of partnership liquidation, and they don't help the timing of distributions. So, how do we compute saved payments? The first thing you do is you begin with the partner capital adjusted for outstanding loans. Assume that all non-cash assets are losses. Distribute the losses to the partners. Plan for other loss contingencies. In other words, distribute contingent losses. Redistribute possible losses. Adjust the P&L ratio. And then saved payments are made after non-partner creditors are paid. So here's an example of saved payments. It's good to talk about it. It's better to show you in a problem. So B, M, and N partnership has the following balances. As you can see here, the cash, there's a loan from Max, land building, a loan payable to Nan. Buzz capital is 50%, Max capital is 30%, and Nan is 20%. All right, so the first thing we're going to do, we're going to prepare a 4-part saved payment schedule where we net out the partner loans and capital, assume non-cash assets or losses, allow for other losses, we're going to assume 10, and redistribute partner losses. The saved payment schedule, I brought in the information. Let's just walk through this nice and slow. So the first thing we do is we broke out the equity that we had in the net of loans. So the net equity net of loans, and you can see the breakdown is, let's see if I can write this up here. 130 here. I just like to pull out my calculator. It's 130. I want to show you where we got these numbers. 130 plus 60 plus 50. All right, so there's 240, 130 plus 60 plus 50. Now, what's missing from that so that it doesn't equal? Right here, this loan, net of loans. Okay, so the loan just gets shaved right off. Okay, now let's look at the asset situation. Okay, the next thing we're going to look at, remember that one of our steps was to go net of assets. So we've got this asset of land right here, asset of building. Let's go net of last asset off right here. Now, once you figure that part out, then you just go in and break it by the percent ownership. So 50% to Buzz, 30% to Nan, 20%, or I'm sorry, 30% to Max and 20% to Nan. So that part's really easy. All right, then the other loss is going to be the loan right here. We take that loan like a loss, 5, 3, and 2. All right, we sub this out. All right, now here's the big kicker. Buzz loss. We have to pretend like we are going to lose from Buzz capital. All right, so the ratio is 3 to 2. And that here is Buzz's subtotal, right, which is 35. And we have to somehow share this loss out between the other people, because you can see right here, Buzz is in the red. So what we do is we're going to add back this loss, 35, and then we're going to distribute it 3 to 2. Where did I get 3 to 2? Just so you're trying to remember the ratio, 30 to 20. Max is 30, Nan is 20. That's where the 3 to 2 comes from, right here. Okay, it's not that hard. It just feels hard because it's ratios and lots of numbers, but it's really not that bad. So I take these two losses out, okay? Now, Buzz is up at 0. Nan is now in the red because bite my tongue. Buzz is up at 0. Max is now in the red because Max had to endure Buzz's loss. So now what we have to do is take the Max loss out and put it over here with Nan. and then finally the safe payment schedule, Nan can have $70. Let's look at partnership liquidation. Okay, so let's look now at the cash distribution plan and a partnership liquidation. A cash distribution plan can be prepared at the start. So what you'll do is you'll rank the partners' vulnerability to losses from most to least. Now, I specifically remember doing this last year and trying to remember who was the most. It feels backwards. I'm just going to give you a heads up. It feels backwards because the most vulnerable is usually the weakest of the group. The least vulnerable is the person that is the last in the rank. So it feels very backwards. So just know that. You'll prepare a schedule of assumed loss absorption using vulnerability ranking and a cash distribution. Then, okay, so now we're going to look at the vulnerability ranking, and the vulnerability ranking is defined by your book as a ranking of partners on the basis of the amount of partnership losses they could absorb without reducing their capital accounts below zero. So the thing that's going to be kind of like drives this ratio is their actual P&L, like their ownership amounts, basically, or their P&L ratios. So you actually have to kind of like have that amount. So the thing is, also, it doesn't matter how much their equity is. You have to use the P&L ratio to actually kind of gross up to find out who's actually vulnerable. Because as you can see here in this particular example, we have Deb, Ken, and Ren with 340, 360, and 160 equity. Now on the onset, all right, Deb and Ren look like they are the most able to handle loss because of their equity, all right. But when you go into the P&L ratio, what you find out is Ren is actually less vulnerable than Deb. Deb is the most vulnerable, Ken, of course, being the least. And you can see the amounts. These are very close in amount, right? 360, 340. But actually, when you add in that P&L ratio, it changes the vulnerability spectrum. So sometimes it can even feel a little backwards. Okay, so now what we're going to do is we're going to go ahead and run through the loss absorptions in step 2. All right, so we'll break down Deb, Ken, and Ren. All right, their equity of 860. And then what we're going to do is we're going to wipe out Deb. So we're going to just take her out of the equation here. She gets wiped out and it's broken between Ken and Ren. All right, for a total of 680. All right, now in the next step where we're going to wipe out Ren, to do that, we're going to take his vulnerability of 800, right here, Ren, subtract out Deb's 680, which we just did, then multiply it by 50 plus 20%. All right, so if you subtract that out, it's going to end up, this particular amount is going to be $60. And then you're going to break that 60 between Ken and Ren. And then after that's done, right, then Ken's amount is going to be 24, and Ren's amount is going to be 24, and Ken's is going to be 36. Now, if you want to shortcut this, all right, for the 24, like just to like make another way you can apply this problem. I never like to show you a second way, but sometimes I think there's an easier way to do that. You can come in okay, you can come in and look at the amount. Well, you know what? No, never mind. Let's leave it alone. Too much. Too much. Okay, carry on. There's a shortcut, but we'll just leave it out. Let you figure it out. Okay. I was going to say you could divide it by 40%, but I don't want to do that. I don't want to blow you all up and confuse you. So, okay. And you can see the cash distribution plan. I really don't want you to worry too much about this because it's not on your homework that much. But I just want you to be aware of how to look through it and do it for the cash. I'm not too much worried about that. All right. So I'll pop past this. All right, let's look at an insolvent partnership. After all the non-cash assets are converted to cash, what happens if there's not enough money to pay the creditors? You can ask creditors to accept only partial payment, or partners may have to go to their personal resources. They also could go to solvent partners. The Uniform Partnership Act requires partners to pay their own share of unsatisfied liabilities and partnership and pay the proportionate share for the partners who don't. Okay, so final thoughts here. I really just want you to realize the accounting implications of having a partnership, the risks that the partners take on, the benefits of it, and some of the rulings of the Uniform Partnership Act. I would definitely understand how to rank the partners, maybe not necessarily distribute after the ranking. And I'd also like you to understand the cash distributions. We're getting closer and closer, so keep working hard and have a great week. Thank you.